Thank you. Today, I want to talk about something a little uncomfortable, something the industry doesn't want to discuss openly because it disrupts a very profitable narrative. And that narrative is that Bitcoin can generate yield, well, at all, but safely, predictably, and without trade-offs. That doesn't exist. That is false. Uh, Not because people are dishonest, but because the language we're using has become detached from the reality of what is actually happening. I'm so grateful to be here. My name is Alex Blume. I am the founder and CEO of Two Prime. We operate an SEC-registered investment advisor. We are a CFTC-registered commodity trading advisor, and we trade Bitcoin derivatives to generate alpha, and we do one of the largest Bitcoin-backed lenders in the world. We also hold Bitcoin ourselves as operating capital, not as ideology, but because we think it's a good asset to hold. It's worked well for us over the last 7 years. Our clients include many of the largest Bitcoin treasuries in the world, about 8 public companies, some here, including many of the largest on the rankings. And so this gives us a unique vantage point. We see the institutional pressures firsthand, the board meetings, the shareholder calls, the questions about making Bitcoin productive. And we also see what happens when those questions get answered with solutions that can sound sophisticated, but are actually just tail risk dressed up as yield. The thing about Bitcoin is that there's a lot of tail risk. It is severely mispriced, and it eventually happens. We just saw a 4 standard deviation move earlier this month. So over the next 15-ish minutes, I want to strip away some of that jargon and show you what actually is real and what is possible and what you need to understand before making decisions about Bitcoin treasury management. So it's not a product pitch. I'm just hoping to impart a framework for how you can think clearly about risk. So let's begin. Once Bitcoin moves from speculative bet to treasury asset, once it appears on a balance sheet, once it's no longer some crazy founder's wild idea, but it's a company's, especially public companies, strategic capital, there's a whole new set of pressures that appear. Now you're on board meetings, you're talking to shareholders, and it all shows up basically as one reasonable question, which is, can we make this asset productive? And it's not a greedy question, it's not irresponsible, it's a sign of sophistication. The person asking it understands opportunity costs, that sitting idle cash sitting around has its own risk. And so this is modern treasury portfolio management. And nobody with $500 million would just sit on it in a bank account earning nothing or 0.1% or whatever banks do now. And so the problem is not the question of what can we do to make this productive, it's that a lot of the answers marketed right now are very dangerous. They seem very low risk, and they're not. So let's first talk about what is yield. Like, I know we know what yield is, but the common understanding of what yield is like a treasury. It's something where you, for providing capital itself, you're getting paid a risk-free rate. There is no risk-free rate in Bitcoin. It is not possible. That's it's a feature of Bitcoin. It is a sovereign asset. So calling any products yield in various ways, it conflates income with risk-free returns. To earn a return on Bitcoin, you are inherently short something, some kind of risk. And so part of the confusion comes from how casually we use language. Yield has a definition. I guess there's you could just do a math problem, but usually when people talk about yield, they're talking about treasuries or risk-free rates. It implies predictability, and it implies a high expectation you're going to get your principal back. Treasury bills, again, that's what generates yield. Investment grade bonds generate yield. Yield is extremely boring. It's very low vol. And that's not Bitcoin. Bitcoin is not boring. Bitcoin is highly volatile. Bitcoin is convex. Bitcoin is a strategic asset with different risks. So when we talk about Bitcoin yield, we're already outside of these mainstream financial definitions. It doesn't make it invalid to want to make a return on your Bitcoin, but it's not yield. And so I think we just need to be explicit about what actually is happening, because Bitcoin does not pay coupons and does not produce yield. It does not distribute cash flows. It doesn't yield anything by default. If you're getting yield, you're doing something, whether you know it or not, that's taking some kind of risk. You could be lending it, you could be leveraging it, trading it, writing options against it. exposing it to counterparties and the risks there. And that's not a criticism, it's just a categorization. The yield is not intrinsic to Bitcoin, it is compensation for risk. So here's what people believe when they start exploring Bitcoin yield strategies. They believe that if they're just disciplined and if they work with really sophisticated counterparties, if they use the right structures, they should just be able to make a return without ever losing Bitcoin. And I think especially in tech, like we use all this Bitcoin jargon and it's as though the normal rules of finance don't apply. But if you don't understand what anybody's talking about, it's not because you're dumb, it's because it probably doesn't make a lot of sense. And so people want to preserve upside, they want to minimize vol, they want to avoid losses, permanent losses, and they want to return. And so you can't have all those things at once. What actually exists is different kinds of risks to take. And often they're marketed as yield, they're risks, and they can blow up in your face. And that's the entire story. Every strategy, every product, every method, claiming to generate income is compensation for risk. It's not yield in the traditional sense. And the smoother the yield looks on paper, the more likely it's just risk deferred, black swan risk. Hidden, and it's compounding quietly in the background until until it's not quiet anymore. Historically, Strategy, this conference, they've generated yield measured as an increase in Bitcoin per share. They sell more shares, they buy Bitcoin, and this works when the market cap of the stock is greater than the NAV. Almost every treasury is trading below NAV, and Strategy itself has moved to selling preferred shares as a fundraising mechanism, and they can uniquely do this. They're way larger, they have a deeper liquidity, they have a derivatives market, unlike almost anybody. Metaplanet is the second closest and is doing similar stuff. For almost everybody else, this is a dead-in-the-water strategy. So other ways of generating income, not yield, on Bitcoin to be differentiated, as Gordon was saying before, need to happen if you're going to put this asset to work. So, and I think that companies that can show consistent compounding returns should be credited with a multiple, just like cash flows have a multiple. Like if the market believes these guys can grow Bitcoin 4% a year, there's probably a 5 or 7x multiple on that 4% if people understand how it's done and it makes sense in some kind of normal financial framework. And that itself can create an MNAV that allows you to maybe go back to the ATM sales strategy as one leg of a broader strategy. And this is the way we think this industry is going, is operating businesses that generate income, strategies that generate income that can be explained and are predictable. So I know we all know what income is, but that is what is possible on Bitcoin, is Bitcoin denominated income. We can take knowable, defined risks, and we can generate returns. And there's no risk-free return. The best you can do is I can at least know when I'm going to lose and when I'm not going to lose, and manage those risks. Anything else is confused. So let's take a look at how Bitcoin returns are actually generated. There's all these sophisticated, both TradFi words and crypto words, hedge funds, structured products, DeFi, derivatives overlays, Delta One. Many of these approaches, they work most of the time. They're well designed. Some work for years. Some generate good returns, but they don't generate yield. They are risk capital strategies optimized for Sharpe or total return. It depends what your priorities are. And calling them yield strategies creates this impression that you're never going to lose your Bitcoin, that it's stable, it's repeatable, and it's not. Alpha moves around in the market. So you're getting paid a return for counterparty risk or liquidity risk, leverage risk, vol risk, often more than one at once. And when those returns are quiet, it looks super smooth. It can look like a very high Sharpe. If you lend your Bitcoin, it's basically infinite Sharpe until they go out of business. And suddenly you wake up and your losses are very sudden and nonlinear. We talk with companies holding thousands of Bitcoin literally every single day. And across all those conversations, different industries, different kinds of businesses, sizes, they all want basically the same 5 things. They want principal protection, they want low beta, they want low vol, they want low correlation, and they want a 5% return. They would be thrilled. And that is understandable. It sounds reasonable. Sounds like modern portfolio management. It's not possible. All those things at once does not exist. You cannot have all 5. And the one you have to sacrifice for any kind of return is principal protection. So I just need to be clear-eyed about that and understand the dangers in pretending that there's no trade-off to be made. So, for those of us around in the early 2020s, this is what happens when risk masquerades as income. In 2020, 2021, all these lenders were offering I remember when they were offering 10% yield on your Bitcoin just for lending it to BlockFi, for example. Paid monthly, it comes in, it's like a miracle. And then they're all out of business. Genesis, BlockFi, Celsius, FTX, poof, your money's gone. My mother's still waiting for bankruptcy claims from her money in BlockFi. These were institutional companies. They were everywhere. It looked so risk-free. But what nobody appreciated was that these borrowers were taking that lent Bitcoin and doing extremely risky things. They were lending it to hedge funds using massive leverage, trading it in illiquid products. They were making unsecured loans across back and forth to each other with fake balance sheets. And they were taking equity level risk, but being paid credit level returns. 3 to 6% near the end. It was higher at times, 8, 10%. And then when it exploded, they all imploded at the same time, not over months or weeks. Poof, in a day, your 10 sharp strategy is all your money's gone strategy, evaporated. So what'd they get for collecting all these returns for 3 to 6 years? For 3 to 6% returns, they got years of bankruptcy claims and legal fees was the reward. And that's what deferred risk looks like in Bitcoin when it finally arrives. Covered calls is one thing everybody says, oh, you could do covered calls. Yeah, you can make 1% selling a covered call all the time. It looks great. And then you get a high vol month. And again, you can lose years of return in a single day. These strategies work beautifully until they don't. You sell the call options against it each month and you collect that premium and then poof, it's gone. This is just, if you look at covered calls over time, this is what the actual graph looks like, up, 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 and then down, 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 brutally, sharply over time. And these trades have gotten harder. The ongoing institutionalization of Bitcoin, these are very crowded trades. A lot of companies in this room are selling covered calls to generate income. So you're not even being compensated well for this massive vol risk that you're taking. Like I said, a single month, you can lose a year of returns in a single implosion, and it's not pleasant, especially when you have to report to a public company. This is just to say we've seen the market structure shift a lot over the last 9 months, year. Basis trade has gotten compressed. I remember when basis, you could earn 20% just being long Bitcoin and short a future, risk-free, delta neutral strategy is as close to risk-free as you can get. That's getting harder. Basis is down, implied vol is down, and then you get these massive spikes in price that destroy you. There's DeFi yield products. Most of them offer under 1% yield. You're taking all sorts of tech risk. You don't even understand that's wrapped up in jargon to make you think that it's safe. And a lot of them are just doing TradFi regular strategies on the other side. I know because some of them hire us to do the yield on the back end of it, the quote unquote yield. So in the end, you're getting a very poor yield. You're taking a huge tech risk, you're taking a huge tail risk, and you're getting worse returns than just doing it in a TradFi way. You can lend Bitcoin out to other groups. It feels great. Oh my gosh, I'm getting 3%. Some big companies paying me. It seems so safe. People lend us Bitcoin. We trade it and make upside beyond 3%. And so again, you're taking equity style risk, but getting paid credit type returns. And there's a long graveyard of companies that have gone bankrupt. I mean, for those around the 2020s, like Genesis, BlockFi, these were like the leaders of the industry and suddenly gone overnight. So for every goal, there's a price. If you want principal protection, you're not going to be able to get a return. If you want low vol, you must accept maybe risk to the upside or the downside. If you want no beta or or if you want very low beta, there's some kind of counterparty risk. If you want low correlation, there's complexity to it. If you want a 5 to 8% return, you got to take some risk. So what actually is possible? There's unsecured lending, Bitcoin secured borrowing, short vol trading, and delta neutral ARB. For us, we think the real opportunity lies in ARB trades across infrastructure. There's still a fractured market, and the most durable returns come from bridging those gaps and getting paid for it, providing liquidity here and borrowing liquidity over there in delta neutral, risk managed ways. It's not magical. It can be explained. It will not last forever. New things show up over time, but there's gaps between TradFi and DeFi rails, different crypto exchanges, and onshore and offshore markets where you can run trades that offset each other, but have some differentiation in what you get paid for them. So, to me, the Bitcoin Treasury doctrine is don't lose the Bitcoin. That's what everybody wants, is don't lose my Bitcoin. If you could do something beyond that, great, but don't lose it. Rule 1, rule 2, don't lose the Bitcoin. And so, the first, like I said, you don't lose the Bitcoin. And so, for us, it's just about clarity. It's understanding that every strategy, every structure, every method is a decision about what risks you're taking. And if you accept that Bitcoin does not produce yield, if you accept that any return is compensation for risk, you can at least make clear-eyed decisions. You can choose, I want counterparty risk, or I want derivatives risk, or I want directionality, whatever it may be. It's just to say that these trade-offs do exist. So for actual treasury policy, what does it mean? It means changing the questions you ask. It means not asking what's the yield, it's saying, what am I risking? And that language can shape different expectations. And I wouldn't ask, what can I make on this trade, but say, what can I lose on the trade? Like, where's the downside in this? The upside in Bitcoin is nice, but losing that Bitcoin is a question of survival, especially for public companies. And I wouldn't ask who else is doing this or do they seem smart, but ask yourself, does it make sense to me? If it doesn't make sense to you, don't do it. Just because other people are doing it or it sounds complex or sophisticated doesn't make it a good investment. So these are uncomfortable questions that maybe counterparties, they ask us this stuff when people are hiring us. They don't like it. And there's no rush. Like, make slow decisions. If Bitcoin's going to $1 million, $10 million, you don't have to make a decision this week. Like, you should make very robust decisions that are going to last decades. There should be friction in it. Friction is what makes hard decisions become thoughtful. It makes what looks like fancy marketing become sophisticated. So, I'd say for us, like I said, we're not Bitcoin maximalists. I'm here to make money, and I think Bitcoin is one of the best assets to do it. We hold it on our balance sheet because we think it's a good long-term decision for our business, and we manage the risk around it. We run a lending business, we run derivatives infrastructure, we work with hedge funds, pubcos, trading firms, institutional clients, and we see both sides. We see the pressure to generate a return, and we see the products being marketed and the language being used, and we see the risks that are not being disclosed. And so the talk is not about criticizing competitors or promoting our services. It's just to say there needs to be a higher standard and greater clarity on what's being done. And we think, like, if institutional adoption is really going to happen, you can't have blowups of firms and bankruptcies that freak out the entire market and Wall Street. It has to be built on clarity, on transparency, on respect for the fact that Bitcoin is hard, treasury management is hard, there are no magical shortcuts or little turnkey solutions. It's not going to be built. The future isn't yield. It's not available. What's possible is clarity. Clarity about what Bitcoin is, what Bitcoin yield is not, and what trade-offs you're actually making. And those that are willing to make those hard decisions with maybe giving up what they think is a 20% return to get a 5% return are the ones that are here to stay. There will be inevitable volatility, market dislocations, counterparty failures. That's all still ahead of us in many ways, maybe soon with the market down. And they'll become as understood from the beginning. It's not about squeezing out every cent. It's about discipline and survival. It's about long-term thinking. It's about knowing what you're risking and why, and being honest with your board and your shareholders and yourself about what you're in this for. And so that's the work ahead, is not yield products. It's better questions and better partners. So thank you.